This property tax bill that surprises almost every California homebuyer. Have you ever bought a home in California, opened your mailbox a few months later, and found a property tax bill, even though your taxes are already included in your mortgage payment? Your first thought is usually, wait a minute, I've been paying my lender every month. Why am I getting another tax bill? This answer surprises almost everyone, and here's what's really happening. When you buy a home in California, the county reassesses the property based on your purchase price. But that reassessment doesn't happen overnight. In fact, the county is often still billing property taxes based on what the previous owner was paying, sometimes over a year after you purchase the property. Imagine the seller owned the home for 30 years. Thanks to Proposition 13, they may have been paying taxes based on the assessed value of $400,000. You buy the home for $900,000. Your lender knows what you paid, so if your taxes are impounded, they often begin collecting the escrow payments based on that higher purchase price. But here's the catch. The county may still be sending a regular property tax bill based on that old $400,000 assessment. So for a while, your lender may be collecting enough money to cover taxes on a $900,000 home while only paying the county's current bill based on the lower assessed value. Where does the difference go? It doesn't disappear. It stays in your escrow account, waiting for future tax obligations. Then, once the assessor completes the reassessment, the county calculates the difference between the old taxes and the taxes that you should have been paid based on your purchase price from the date, and you become the owner. That's called a supplemental property tax bill. And here's the part that catches people off guard. Even though you've been paying money into your escrow account every month, the supplemental tax bill is often mailed directly to you, not your lender. That's because most lenders are set up to pay your regular annual property tax bills, not necessarily the one-time supplement assessment. Some lenders will pay the supplement bill from your escrow account if you contact them and there are sufficient funds available. Others require you to pay it yourself. Every lender has its own policy, so don't assume either way. Now you might be wondering, if my lender has been collecting extra money all this time, do I ever get that money back? Sometimes yes. Your lender performs what's called an escrow analysis. They compare how much they've collected and how much they'll need to pay for future property taxes and insurance. If there's more money in your escrow account than they're required to keep, they may send your escrow a refund. If they need the funds for upcoming taxes, they'll keep the money in your escrow account to pay those future bills. The important thing is to remember this. A supplemental tax bill is not a mistake. It's not double taxation, and it doesn't necessarily mean your lender did anything wrong. It's simply California's way of catching up your property taxes after your home's assessed value changes because of the sale. If you're buying a home in California, one of the smartest things you can do is estimate your supplemental property taxes before you close escrow. That way, when the bill arrives, it's expected, not a financial shock. I'm Carol Ann Mills with Keller Williams LA Harbor Realty. If you're buying or selling in California and have questions about property taxes or any part of the home buying process, feel free to reach out. I'm always happy to help make real estate a little less confusing.